Imagine this, a billionaire sitting alone in his office, mahogany desk, floor-to-ceiling windows, a city built by his money outside, and in his hands a letter from his bank saying, "Collateral insufficient, liquidate assets within 72 hours. 2 years ago, he was worth billions. Today, he has only 2 choices. Give up the private jet or lose everything." And this is not a movie scene. This is happening quietly across the world. In the last 2 years, major financial trackers have shown that dozens of billionaires lost 30, 40, even 50% of their wealth. No press conferences, no headlines, just silent selling. Today I will show you exactly why the richest people on earth are quietly breaking and how this same system can affect you next. Let's begin. It starts with one number, 5.5%. The US Federal Reserve interest rate in March 2024. 3 years earlier, it was 0, and a rise this fast had not happened in over 40 years. When money becomes expensive, cracks appear at the top. Carl Icahn, an 88-year-old Wall Street legend, learned this in 2024 when a research report questioned his company and the stock collapsed in one day. Then banks recalculated his loan collateral because he had borrowed against his own shares. Margin calls followed, and public filings later showed his paper wealth falling by billions in months. When leverage meets falling prices, time disappears. Then came the younger billionaires. Sam Bankman-Fried was worth over $20 billion in 2021. In 2022, his crypto empire collapsed. Customer funds were misused, liquidity vanished, confidence died. Within days, bankruptcy. Within a year, conviction. FTX was not unique, it was a warning. The same pressure was building inside office buildings. In early 2024, reports showed half of Manhattan's offices were empty. Remote work became permanent. Buildings once valued near $1,000 per square foot struggled to sell even around $400, and those buildings belonged to billionaires and were bought using borrowed money. Over $1 trillion in commercial property loans reached maturity and needed refinancing at higher rates with lower property values. Banks hesitated, deals froze, defaults began, and one major investor admitted publicly that loans were not being extended. Private equity followed. Trillions invested during cheap money years at extreme valuations became trapped as IPOs slowed and buyers disappeared, and even the biggest tech funds admitted massive losses, with one famous investor saying they believed prices would keep rising, and they did not. Then came the quiet. Signal as auction houses confirmed private. Luxury asset sales surged. Paintings, cars, villas sold discreetly, often far below previous prices. No headlines, no explanations, because cheap money created confidence. Confidence created debt. Debt met higher rates. Prices fell, and debt remained. So why does everything still look normal? Because reputation is currency, and if markets sense weakness, banks tighten credit, partners leave, stocks fall, so stress is hidden. Jets still fly, but leasing replaced ownership. Yachts still appear, but sales take longer and close far below asking prices. And maintaining the lifestyle alone costs tens of millions per year when you add aircraft, crews, security, homes, and staff. So when investments stop paying, that money must come from somewhere. In 2024, Reuters described a tech founder who lost most of his fortune and said that on paper he was rich, but in reality, everything was locked. And surveys confirmed many billionaires privately worry about liquidity. At wars, energy shocks, inflation, and aggressive rate hikes. And even Elon Musk saw his wealth swing by tens of billions because stock-based wealth is fragile. When shares fall, collateral weakens, credit tightens. One failure makes lenders nervous. Nervous lenders tighten rules. Prices fall, more failures follow, and that loop is called a vicious cycle. So what does this mean for you? It means money rewards preparation, not confidence. The first lesson is leverage is dangerous because borrowing multiplies gains and destroys people in downturns. And as Warren Buffett said, cash is oxygen, and without it, you suffocate. The second lesson is real diversification. Stocks, bonds, gold, commodities, and cash. Not excitement, but survival. The third is liquidity, because cash is boring until everything else burns. The fourth is that FOMO is poison. Crowds buy at the top, and professionals sell quietly. 1929, 2000, 2008, 2020, 2022. Same story, different technology. The fifth is education, because markets respect discipline, not motivation and fast money promises. Sell hope, not skill. Rates will fall someday. Liquidity will return someday. Timing is impossible, but survival is not. Billionaires failed because they believed rules did not apply to them and the market disagreed. Ordinary investors have one advantage. They do not need to look rich. They only need to be stable with quiet investing. Long horizons, compound growth, slow, boring, unstoppable. Wealth is not what you earn. It is what you keep and how long you keep it. The market does not care who you are, only how prepared you are. And that is the real story behind the billionaire collapse. Use it wisely. Now this is the video end. See you in the next best video. Bye bye.